Hello everybody, Ken Krager from Black Swan Financial Advisors here. Hopefully everybody is doing great. Oh, I gotta make my picture a little bit bigger. Okay, here we go. Did that work? There we go. I was playing around with it yesterday because I didn't want to look at my face so much. So anyway, this will be short, quick, sweet, hopefully informational for you. I hope you're getting some value out of these videos and so forth, out of my video podcast, Black Swan Breakthroughs. Anyway, today, again, these videos are all for educational purposes only. There's my website. Actually, I have a draft. Hopefully it will be live in a few more weeks, so around the 1st of July, 2023. There's my YouTube channel. Please subscribe to my YouTube channel and please send me an email if you would like to talk. Today, I wanted to talk a little bit about the current situation of the American economy and the stock market, kind of related to that, but it's the economy, especially for the last year and a half. It's been like walking on eggshells. Inflation has been really high. It's really, I felt it in my own family and our own budgeting and so forth. But what's really going on, and especially since the S&P 500 is up 20% this year and the NASDAQ is up 35. Now the Dow is only up, I think, maybe 10 or 12% or something. So, which kind of shows you, though, that the market is made up of sectors, and you can have bullish sectors and bearish sectors at the same time. But let's just talk about this economic engine that just keeps chugging along, and I think it's stronger than most people think, and maybe even what most of the data that we hear about all the time, right? And the Fed just came out yesterday, and they did not raise rates this time, but especially the core inflation, 5.3%, way above 2. It's likely they'll raise again a little bit in July. But anyway, our economy is driven by the consumer. More than 70% of GDP is consumer driven. And that means as long as the consumer keeps spending and feels like they can keep spending and they don't start to huddle down and start saving more than normal, right? Then the economy will keep growing, maybe not as fast as it was before, not by any means, but so probably out of all the indicators that you can watch just to kind of see about the health of the economy, and that should drive profits, which should drive stock prices, right? But you need to watch the consumer. And there's two bits of data that tell the story of what's going on with the consumer right now, and I find it really interesting. We're likely maybe in a recession, a light recession, or going to be in a recession. But if the consumer keeps spending, the economy is going to keep chugging along. So let's look at two data points that kind of illustrate this point. So one of them is credit card delinquency rates. What are people actually doing with their money? Now, when things get hard and bad and the economy's tough, the household economy, people don't pay certain bills, right? And especially if you have a 25% credit card bill, you might let that one go for a little while. And so credit card delinquencies are one of those things that are a pretty good indicator of how the consumer is doing. And yeah, you can see that it's ticked up, last year and this year. You can see 2020, it went up, but it was pretty normal, but people really hunkered down after the pandemic, and they were paying their credit cards, and they were saving their money, and they weren't spending on extra stuff, right? And then we have seen as the 2022, late 21, 22, and now it's going up, but you can see it's still well below normal, way below normal, right? So the delinquency rates are nowhere high. I mean, it's really kind of interesting that we have a banking crisis because of the Fed's raising interest rates, and basically the yields and the bond, the value of the bonds going down so much, like 20 to 25%. It's not caused by people not paying their credit cards. And so the trend is up, and we need to watch that. But it tells me that people, they're still spending money, because if you stop paying your credit card bill, you can't go use your credit anymore, right? So, so the delinquency rates are still pretty low. So the other one is a personal savings rate. And again, actions count, right? What people do is what counts, right? It's not what people might do, like the Fed. They want employment to go down. They want people to lose their jobs because then they'll stop spending. Now think about that. If you lose your job, your personal savings rate is going to go down even more, because you got to start spending your savings, and you might stop paying some of those credit card bills. So what will happen is both of these indicators will show, as as the economy really tightens up and people start losing jobs and everything like that. So I just want to say, people in the U.S., we stink at saving. We have an abysmal saving record. That's why most people, more than 50% of them, by the time they reach retirement age, they can't retire. We have a very poor, if you look at this average, the savings rate, if you're lucky, 5% on average, 6-7%, and really, to be successful for most people to be able to retire, you need to be saving between 10 and 15% of your income every year if you can. So the savings rate is lower. It actually been ticking up a little bit. So it came down. You see, people save, they hoard their money, right? It's a hoarding kind of thing, right? When things get tight, if the people that still have the jobs and stuff, they save more because they might lose their job, right? And so you see that in 2020, 2021, during that pandemic crisis, savings shot way up. And so, and you see a little spike here in 2009, but especially during the pandemic, the more unknowns there are, the more people will increase their savings and start hoarding their assets because they have no idea what they might need. So this is telling me that, at least right now, that the economy is chugging along, and you really probably need to be participating in the stock market if you're not. I mean, 35%, 20%, those are significant gains. And even though you can get 5.25% on a 1-year treasury, some of your money probably should be in equities right now. Again, this is for educational purposes only, but it's something to think about. But I don't know. Most of you might not realize that there are investments that you can do in the equity markets where you give up some of the upside, right? So you wouldn't make that 20% this year, but maybe you would make 10 of it, 50% of it, or 60% of it. But in a down year, you lose nothing. And so there are investments like that. Please contact me. We could talk about those. They're really powerful. I have a significant amount of my own assets, especially as you start approaching, 50 plus, approaching retirement, where you cannot afford. If you look at that chart from 2009, 2008, it took 13 years to break even. And I'm too old to lose half my money and take 13 years to get it back. So I would rather make half of 20% on a good year and lose 0 on a bad year than to make 20% and then lose 30. And so anyway, there's some really powerful investments there. Give me send me an email. Thanks again. We'll see you later. Bye.